Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with Kevin Casey, and today we are joined by none other than Bill Dallas. Good morning, Bill. How are
Morning,
you?
y'all.
Good afternoon, wherever you are in the world. A couple things. First of all, this week is a short week. Did you know? So tomorrow
Yeah, that's
we have
actually today's end of it.
no, it's not. Tomorrow we
Yeah,
have
no, Trump made a holiday
okay.
Wednesday and Friday and Thursday.
Okay, don't start. We are all going to continue to work today and tomorrow. Well, most tomorrow.
Well,
So,
no, it depends on your mortgage company because some
oh
companies went with that.
I am going to beat you. Oh, sorry. Okay, so mortgage applications tomorrow, initial jobless claims tomorrow, but the market closes at 2 p.m. Eastern time. Thursday, the market is closed. Friday, the market is open, but no reports. So that's always dicey because we'll have light trading. So whatever does happen in the market is going to be completely inflated and go really big one way or the other. So buckle up, babies. So the last time I looked this morning, the 10-year was at 4.17. It was pretty flat. And
Mhm.
mortgage-backed securities had made it staged a comeback from being down like, I don't know, 20, 21 this morning. And again, last I looked, they were down 5, but they were sort of fluctuating. So, you know, as usual, it just, just it's up, it's down, it's up, it's down.
Oh,
Um,
wait, are you saying that the mortgage rates did not drop by a quarter when the Fed announced the
Oh, you're so
rate
funny.
for?
You are so funny. Okay, so I have been talking about NMLS for literally months, and at this point, my message is this. It's probably too late, but give it a try anyway. At least get your stuff done by the 31st, but you're going to be out of business, so you should have listened to me earlier. Okay, I just want to wish, just in case you're sick of all the commercialism of our holidays, whether no matter what your holiday is, today is Festivus. Happy Festivus to everyone. Are you familiar with this holiday, Bill?
No.
Oh my God. Okay, well, if you need to lighten up a little bit, people, go and watch some clips from Seinfeld. This was Frank Costanza's holiday, George's dad, and it is my favorite. I have clients who literally,
It's Festivus for the rest of
yes,
us.
Festivus for the rest of us. I have clients who ping me every single year. So I just thought I would give you some ideas should you need them in case you needed
I,
something
I
other
have
than.
seen some Festivus poles all lit up in front of
Mhm.
people's houses.
Okay, so aluminum poles, you don't need to decorate them because according to George Costanza's dad, I find tinsel distracting. Oh my
Uh,
God. So you have the feats of strings. That is where the head of the household is being wrestled until they're pinned to the ground. You
uh,
have a Festivus dinner that usually involves meatloaf, and you have the airing of the grievances where the participants do a recap of all the ways others have disappointed them this year. Oh God, this makes me laugh.
it's
Okay,
so good.
and then there are Festivus miracles, which are not, your average miracles involving angels and maybe God. No, no, these are really frequent but unimpressive miracles like walking the groceries into the house without tripping. That would be a festival miracle. So,
Mhm.
people, this gives you something else to focus on. And if that wasn't enough for you, also on December 23rd, but in 1913, President Woodrow Wilson, say that 3 times fast,
Yeah,
signed the Federal Reserve Act creating the Federal Reserve System. How about that?
it's pretty we should big. celebrate that. How many
Okay,
years is that now?
what?
That's
Oh,
a It's
sorry.
hundred and probably, 12 yeah, it's years. probably, yeah.
Yeah. All right. So happy Festivus. And also happy birthday to Bill yesterday. Should we sing? Yeah. And to Jason Bellevue, our friend who does our YouTube channel and also who is the president of the California Association of Mortgage Professionals. So happy birthday. Happy birthday. If you know him, ping him on Facebook, give him a call, sing to him. He'll just love it. Right, Kevin?
Oh, yeah.
Yeah.
Get right back to you, too.
Oh, geez, Louise. Okay, so another little point of interest I thought was that as of January 4th, 1st, sorry, California Senate Bill 721, the inspection of exterior elevated elements. That means you have to have all of your buildings with 3 or more residential units without an HOA inspected and attended to. So I got this message and reminder from a lender. So they are going to be looking at whether or not you have had your inspections done on your buildings that are 3 units or more. So there you go. That's your public service
Wait,
announcement.
wait, say that one more time. So that he has to inspect. If you add an ADU, you have to have it inspected, even though you built it with permits and everything.
For buildings with 3 or more residential units without an HOA, with exterior elevated elements and associated waterproofing elements as defined, including decks, balconies, and stairs that rely in whole or in substantial part on wood structural support. So note,
Oh, so
and 3 to 4
and
units with HOAs are covered under a separate bill. And then you have to have subsequent inspections completed every 6 years. So
so if
I
you
knew
own a
you were going
three
to
or
ask me
four
more
unit
questions.
building, you have to have the decks
Okay.
inspected now.
If you have questions about this, Google, ask our friend Google, California Senate Bill 721, SB 721. All right, moving along. Are you good with that, Kevin?
I'm writing it down.
Okay, good. Yeah, you just check into that later, okay? Make sure you have all the details. So, Bill, there's a lot going on these days, as usual. So, I wanted to talk a little bit about, how we're wrapping up 2025 and what we can look forward to as we go into 2026. So, why don't we start with your thoughts?
Yeah, I mean, I think it's a bit of the same year, but it's a little bit different than what we just experienced. Like we were talking before, I think people are forecasting originations and to be up a little bit, 20% maybe. So I encourage all my clients to, like you were saying, to budget. I mean, if you're not going to do 20% more, then you're falling behind, right? So you got to, as a loan originator, I think you need to expect, and Kevin was talking a little bit. I mean, borrowers I think, will start crawling out of the woodwork. I
Yep.
don't think it's going to be like termites that have infested everything, but I think it will be more solid. And I think people are getting more used to, sort of I think rates sort of at this elevated level, even though you still feel the lock-in effect, right?
Mhm.
I think now you're getting more of this maturation of people who are whatever your situation is, where you have to move, or you need the cash, or you need something else. You see all of that beginning to occur now, right? So 2026 should be, I think we've, like mortgage bankers, right? We're close to 75, 80% purchase. I think you'll see more refinances, albeit you might see more requests for HELOC, more requests for second. But I do think, you watch the debt component of consumers, it's rising pretty fast. So they'll use the HELOC if they own a home to pay that debt off. So I think that's probably one is if you're, I guess the headline would be if you're going to be up 20%, right?
Right.
Overall. I think I think probably maybe maybe a bigger issue or bigger question is just I do think and agree with the idea that this is the beginning of an industry reset. And I think if we look at the top side of the business, right? I sent it to my clients, and you've seen it to discuss on Chrisman and a couple other things. Just the big transactions that have happened. I mean, why is that happening, right? Why did United Wholesale buy Two Harbors,
Right.
right? Why did I mean? And before that, you had really this Bayview combined with Guild. And then you had before that, you had this big transaction where you had Rocket, actually merging and acquiring probably one of the largest portfolios on the planet. So I think to originators, and then if you take the credit trigger legislation that passed earlier, and when it comes into effect, right, there's no more selling someone else's mortgage data,
Hmm.
and you're not going to get these thousands of calls, in a credit pool. So, and why did these, I always ask the question, why did these people go on a shopping spree? Right? What is the purpose of that? And so if you really think about it, I don't think they're just buying servicing income. I think they're buying permission to speak to the borrowers when rates drop and you're locked out.
Yep.
And so my goal, and I think they think the refi wave will come. And the question I think to your clients and all of us on the call today is who is servicing your borrowers? What is your strategy to ensure that they don't refinance away from you when that opportunity comes back? And how do you compete? And I think if you really look at the window, I mean, I was originator like you guys, right? You don't really want to do a second because it's a small loan balance and you don't make any money and you sort of lose control, right? If you get used figure or you go to somebody else, right? So now you're left with a first. Well, do you really want to refinance a first, a 30-year first above six, six and a quarter, six and a half? So you see this movement, you see a lot of FHA, lower rate, but much higher, closing costs. Probably not, but I want to be in the fives. So I really think the non-QM product of 2026 is going to be the 5 and 7 year arm.
Mm.
And it's probably going to come from for brokers and originators, it's probably going to come from your bank partners. And the banks, and why? That's going to be at 5.5. I mean, the thing that's changed over the last 2.5 years that's totally different is the yield curve is now actually a yield curve.
Right.
And so you don't have this inversion that we've had that you guys have had to live through for
Yep.
really the last 4 or 5 years. So
Mm-hmm.
now I think the 2 year, so what we were saying, right? That most of us look at that 10 year and say it's not fricking moving when the Fed makes a change, but the low end does. The low end actually it rallies a bit and gets a little bit lower. So now you're actually seeing the 2 month, the 1 year, the 2 year, and those actually begin to look more like the standard curve. And then you had Trump come out, and a lot of people talk about the 50 year. Well, we've talked about it, right? The 50 year is going to price off the 30 year. The 30 year bond is going to be much higher than the 10 year. So what are we talking about this for, right? So I think when you look at my thesis is prepare for non-QM, and non-QM is not it's a HELOC and it's a 5 and a 7 and a 10 year arm. And those are just standard products. Then you start looking at what I would say would be the world of non-QM, which then allows you to maybe get to easier. Maybe it's underwriting guidelines, it's FICO scores, it's all the things that your clients,
Yeah.
when they bang their head against the wall in life, that they need a loan for, right? So I actually think when you look at if I look at it a little different, right? Because when you look at United Wholesale and Rocket, two of the largest, I would say correspondent buyers, aggregators, right? When they buy MSRs, why? Because they're a broker. I mean, it's not a consumer direct play, and you don't have the banks. I think the other headline would be that banks are going to because the five and the curve is actually straightening itself out. Banks will come back a bit with a vengeance. So remember when we used to do this, right, prior to 2018, probably for 10 years, what do we talk about? Banks kicking our ass,
Mm-hmm.
right? And I think for each of you, I would make sure I line myself up with the right bank partner so I could do my 5 and 7 and 10 year arm, right?
And regular DSCR repertoire. But
Yeah.
I can just jump in here for a minute. Just a couple things. Number one, when we're talking about 50-year loans, I saw a headline this morning in the Wall Street Journal and took a little dive into the subject. I didn't realize there are 100-month loans for cars now. That's so, and it was interesting because a lot of the pros and cons were very similar to a 50-year mortgage, which is negative equity potential because we know that cars depreciate the second you drive them off the lot, higher rates and much more interest paid, et cetera. So I thought, oh my God, that's the solution now is just extend the term until, everyone's dead. And so just these are things to talk about with your borrowers as they're making financial decisions. Be a part of that so that you can partner with them
Mhm.
as what is a good idea? What isn't a good idea? This seems like a good idea in the short term, or just, but the, yeah, and don't get me started on,
That reminds me of one of the first cars I ever bought with financing.
yes.
And it died, like literally sat in my driveway for like in the fourth year. So
Oh,
for a whole year, I had to hold on to it while in my driveway while I made payments for a year on it
Hmm.
every month because I couldn't get rid of it until I paid that damn thing off.
that was 4 years. So imagine 8, right?
Yeah.
Yeah.
I had to sit in my driveway for 3 years. Oh,
Yeah, that's
Well,
crazy.
I think too, you don't see, I mean, you didn't have Carvanas, you didn't have all these.
yep.
I mean, the average used car price is like 40 grand,
Yeah, it's crazy.
right? So it's like, I mean, if
Oh, those are
you
your
look,
cars, Bill. I know
no,
you're
I
buying the
mean,
really
I think
nice
it's
high-end
like your
ones.
Suburban and it's all it's the Ford truck. I think all of that is
You have to
interesting
make,
because I think the borrower and the bank and the world got used to the inverted curve, and that
mm,
curve allowed a 30-year loan to be less than a 2-year. And so we all got, I mean, it's almost like we got religion to this. Let's just offer a 30-year fixed rate loan. Well, banks have never been comfortable, and a lot of banks bankrupted themselves trying to actually hedge it. They don't understand it, right? And they don't really want to sell loans to Fannie Mae and Freddie Mac. And so that puts you back to, okay, this is target rich for banks. And so I think this isn't, I mean, when you look at the transactions, and I encourage, because I think as originators, sometimes we don't look at the macro factors, and it will rain down on us and have an effect on us. So we probably went through a period of time where nobody was really cared about the servicing.
Right.
Right now, this industry reset isn't just about originations plus servicing, right?
mm,
This is about a multi-dimensional restructuring of the chain, of the value chain, which will affect the originator. Because our job is to, how do we keep the relationship if we have to sell the servicing or sell a client,
yep.
right? It's that simple.
And there
Bill,
are bad servicers out there. I've
I,
had,
Well, they're all bad,
no,
really. I mean,
no,
they're
there's
there are,
some
not
that are worse than
really.
others.
Well, but I'm more concerned about you sell your loan to an aggregator,
Hmm.
and now the aggregators developed they either bought Guild or they bought their way into the value chain so they could actually potentially keep the client, right?
Yeah.
It's more tech enabled. I think there's this whole challenge of the end game on resilience across cycles for most of these big players. It kills them. So
mhm,
they're trying to figure out the right model by controlling the borrower with touch points along the way so they can monetize the life cycle and recapture the client with ancillary revenue streams and other things that they could offer, from anything from insurance to cars to personal loans to whatever. And if you really think at the value chain in mortgage of what's, if Fannie, because I also think Fannie and Freddie could be privatized. And that, if you really look at value, what mortgage bankers have missed have been a couple of things. They've missed non-owner occupied and flipping, and that's gone to other players,
Yeah.
right? They've missed, and then I think they miss HELOCs because they don't really do those well, and we don't do cash out well. That's not our thing, right? We're a
Right.
purchase driven industry. And then we don't have other ancillary services, and then we sell the servicing. So we have got to double, with the laws changing and everything else, we've got to get much better at retaining that client relationship. And because I do think you have an edge because you're in the community, you know your client, you know all those things. So how do we basically make sure that we step inside so that we can continue to control the client, and forget this massive AI infrastructure and all this budgeting around firms actually now creating bots that can make all the calls on behalf. I mean,
Mhm.
loan officers suck at this. I mean, we are not call center jockeys, right? We don't do that. We wait. Our clients call us generally because it's
Yep.
referral based or somebody will call us. So I think thinking this through a bit is what I would try to do if I running a brokerage when I was just origination only. It was how do I help my LOs double their production, get closer to the client, and then prepare them with products that actually fit for 2026.
I think part of our problem, there's a few things. Number one, our my clients, and not just my clients, when we're teaching NMLS, we're actually asking the other LOs. People hate their servicers. They want to refinance away from their
Mhm.
servicers. So the fact that our borrowers are so aware of their servicers means they suck. And so that is not always going to be an advantage for them, is that they're servicing the loan when they're not doing a good job. And the other thing I want to make sure we make a point of is those 5 and 7 year loans are for a certain group of people who are absolutely solid enough financially that in 5 or 7 years, should the rates be higher than they are today, they will still be okay in their with their payments. Because I have been in the UK and Europe when interest rates were really high and people had to sell their properties because they couldn't afford the new rates that were adjusting. So they had refinanced into a 5 year or a 7 year when the rates were in the twos or threes, and now the rates were in the sevens.
Mhm.
They were toast, and they were literally, I'll never forget this one guy who was selling his three rental properties and his primary and moving out of, where was I? I don't know, Scotland maybe. And so this is something, just like with any time that we are talking to a borrower, we really need to be looking ahead to what is, just like on a private money loan, what is your exit strategy? What
Mhm.
happens if the rate goes up? How am I going to get out of this if I need to? Am I going to be okay? So just be, and this is where our value really comes into play, where you're not going to get that at a call center. You're not going to get that anywhere else. You got to use a really professional loan officer,
Mhm.
not some hack who's just trying to churn numbers.
Yeah, and I think I mean, you hit, I mean, look, playing to our strength is seeing the client. If you want to play to their strength, operate like they operate,
That's right.
right? Just call them or not call them. Or, I mean, I think physical presence, it's almost the same as what you would say, yeah, you can do online shopping, but there are certain products that I want to try on, that I want to see. And I want to talk to a professional or somebody who could do that. But if we don't, if we don't play to the strength of physical, almost conversation,
Yes.
that we're losing our edge.
Yes.
And I think when you look at, like you just talked about, right, products fit different borrowers. That's your expertise. I think being able to stay connected to a client so that I wouldn't say that you're trying to predict, life cycle stuff happens to clients all the time. So we're just how best to stay in front of a client is, and there's all kinds of software, there's all kinds of other things. My view of it is I'm constantly trying to be in contact with my client, with my customer base. How do I do that? Right.
Yes.
And I think it at the physical meeting, the Zoom call, restructuring, the talking to your clients about, what are your goals? What are you trying? It's almost like financial planning. And I don't think we play enough, because we're so purchase driven, we don't play enough to helping people build sustainable wealth.
Right.
I would be having an annual review, trying to with each of my clients and trying to have that discussion of, okay, you've got this much equity. You shouldn't have all your equity. You shouldn't have all your financial net worth in one asset class,
Right.
right? So what do I do to actually manage that, right? Because I actually think, home prices went up, but so did the stock market, right? And so did other asset classes. And people are talking about gold and people are talking about crypto and Bitcoin. I mean, there's lots of other things that folks need to balance when they look at their overall asset pool. And sustainable wealth is just making sure that you're not lumpy. I mean, I know for me it was the same thing, right? When you own your business and you own your one asset,
Yep, you're
how do
lumpy.
you spread that into other asset classes, right?
Right. Especially when you're in all of your equity is your only asset and you can't access it. It's just so,
Well,
you
and you look at that, I mean, the trillions of dollars that are in like Finance of America, my old business. I mean, it's a reverse company today, right? And
Yep.
all of that wealth in over 62
right.
is, I mean, it's gargantuan, the amount of wealth that's been created. Well,
Hmm.
equity and cash are two different things.
Yeah, big
You can
time.
talk a lot about equity, but unless you can have access to the cash, you,
Speaking of reverses, isn't there a proposal now to make it tighter for reverse mortgages to continue with the CFPB?
I think that whole, I mean, basically reverse is a Heckam business,
Right.
FHA driven.
Yep.
So I actually think it there's there's lots of things that product should be more of an annuity product driven by insurance companies, which is sort of the
Interesting.
jumbo part of that
Uh-huh.
industry. And you're going to see a lot of people doing equity seconds to reverse clients to keep them in their reverse loan, right?
So
Which
that's
is
what I was
another,
looking for. So there is a reverse second currently, but it's
yeah.
only behind a full forward first. Are you saying there's a second that's going to go
I
behind?
think that's the strategy is how do you do the same thing, right? To a reverse client
Yeah.
so they don't have to refi and can
Our,
keep it.
our conversations with FHA, they have been very clear they are an insurance company. They're not a mortgage.
Mhm.
So I always,
No, and that's the MIP is pretty much the actuarial part, right? It's so gargantuan. It's not, I mean, I don't know. I know in running, I think for the consumer, there's a product, especially for over 62, for no payment, right? When you've got tons of equity, right? So I think for us as originators, we just need to understand it and how we counsel our clients
Yep.
because they're still, I think it's whether you're trying to retain your low interest rate first or whether you're trying to monetize your equity on the other side, the chasm there is why loan officers exist and why you're good at it. I just
Hmm.
think retaining, it's interesting that a lot of people, the last time we did this in 01, 02, and 03, when everybody started buying, homes and second homes and all these different things for investors, I've just cautioned clients and said, look, you don't want to be in one asset class.
yeah.
You need to figure out ways that you can take your hard-earned equity and spread it into other investments. It's too bad, for most of us, we're not financial planners, but we are. And I've
Yeah.
always said we are, I mean, you can use even in your terminology, we've used the word advisor, but you could be a home equity advisor. That's
Hmm.
legal. And that's important. And I think that's really what we should do is we should be more involved. And when you look at what's happened with insurance costs and catastrophic costs in general, now you've got climate change, the cost of water, the cost of, I mean, when we all started in the business, I know underwriting was off of net, and we did a lot of discussion in underwriting around PITIMU, maintenance and utilities. And that just dropped in for 40 years. Now
Right.
it's sort of coming back because I do think the maintenance and utility cost for some clients is gargantuan, right? And it's going to continue to be something you can't get, maybe need, much more expensive than you thought, and it covers less, right? So it's like, right. And I think all of those things play to why you're the expert.
Yeah.
So I
Well,
think I've had this thought that I was listening to Brian Buffini and Dr. Lawrence Yun give their
Mhm.
projections for the next year and their overview of what's going on. And they were talking about the fact that NAR president was saying that NAR has structured themselves for next year, expecting that we will have 20% less agents in the market, but that they are expecting 14% more sales. So NAR is thinking that less realtors, which again, I'm a big fan of this, both in real estate and mortgage. I have been extremely vocal about it. If you're not a professional who is taking this seriously and really honing your craft every day and working on your business and in your business, get out. Honestly, I'm just so tired of people who are half-assing it and it's a detriment for the client. So I love that idea. I think that the people who are in this business, and I mean, look at the people on December 23rd showing up to listen to this. And and uh, that's crazy, right? So there are a lot of us who are really dedicated to making ourselves better so we can be better for our clients. I think there's been a hyper focus for too many years on the refis. Our When I started in this business, which was 36 years ago, we were focused on purchases. And I think that is a smart way to go because people need a place to live. But our entire industry has shifted the focus to refinance, retention. Oh my God, I got to keep that client. Oh my God, all this money being spent on that, which we can't control rates and up and down. So again, I think that we have gotten maybe too big. I mean, do we really need all these players? But do we have to be thinking, is it really a good idea to have, these huge, huge, huge players who are going to dominate the entire market and decide what is going to happen or not happen? So thoughts around that, Bill?
Yeah, I mean, I think um, I think it's a pro only business.
Should
It
be.
isn't like when rates drop, everybody gets into it.
Yep.
Right. And a lot of that volume goes to call centers and to
Terrible.
people that are just leveraging what the infrastructure of a bank or the infrastructure of some other uh, enterprise. I think, again, playing to our strengths, we have to play, I think, as a advisor, you are your book of business. The real challenge with it is that we're paid upon origination and
mm-hmm.
we're not
Maintain.
paid any annuity like an insurance, and
Yep.
we should be. I actually think with Dodd-Frank, if I could change one thing about Dodd-Frank, it would be I'd pay people so much to originate, and I'd pay people to stay connected
Mm-hmm.
to the client, right? That way you would have this annuity with the client, right? What's your job? Help them pay their mortgage
Yep.
payment. I mean, look at what we did through forbearance. Shit, you guys did all this work and didn't get paid. Maybe you refied them 5 times. I don't know. But at the end of the day, uh, I think, I think part of our job, if not the largest part, is to keep them in their home, help them understand what to do with their equity as they grow and as the life changes. And then I think at the end of the day, try to provide them links and contacts to other services, which you do anyway, right? You help them with insurance, you help them, you probably have a car guy. If they get divorced, you have a divorce lawyer. I mean, it's all these things that we do as an advisor
Right.
that allows you to become their their expert. And I
Mm-hmm.
think when I originated, and I was a top originator in the Bay Area, right?
Yep.
I used my expertise in hard to place loans. And
Mm-hmm.
that was my style. Right?
Yeah.
Yep.
I liked the
That's
challenge
what I
of a
do all
bunch of
day.
confusing shit that the clients would bring to me.
Yes.
And instead of hey, my rate's this and I want to do that. No, I was maybe it was just me. I was just more interested in the complexity of a really messed
I
up
am the
thing.
exact same thing. I like the complexity. If it's the same, like I just did a conforming 30-year fixed loan Fannie Mae product, first one in quite a while, and oh my God, it was so simple. It was like, geez, I should do more of these, but it's like, but that's so
It's funny. One
simple.
of the questions that Romeo had in here, it was, do you see portable mortgage happening next year? No, I don't. I
Hmm.
think the two words that you all don't want to hear from anybody ever is portable, and you don't want to hear the two words note modification. Because if they can note modify or they can make a loan portable, you are out of business.
Yep. Yep.
Well,
Right? So as much as I would like that portable loans somewhat make sense, America is not set up to allow loans to move from one piece of property
To
to
the
another,
next. Yep.
right? And the other thing is, and I'm a lawyer by trade, right? I don't practice, but the laws in recovery for default, you don't you would convert that to a judicial foreclosure, which would then potentially um, make it more like this is that you've guaranteed the loan.
mhm.
As a result, today you all live in a non-judicial environment, right? And it's governed by section, I think it's 2924 of the code, right? So you get this non-judicial foreclosure, which also gives you one action, and that means that they're unable, they being the creditor, is unable to come back to the client for any deficiency. That's
Right.
the beauty of lending, right? It's like I tried, I didn't make it, my house went into foreclosure, I'm out. Well, absent the credit ding, right? You can start over, which was the purpose of the law in the first place. When you start making it portable, then there becomes personal guarantees because the loan's going to continue on. And I think, I don't know, there are so many interesting products
Hmm.
that I think that we can offer. I think the challenge, what I encourage all my loan officers to do is always have a cash out litany of products that I can offer because the industry is so built around a primary occupant purchase,
Right.
right? And that's that's really why you see companies struggle so in environments like this. And I'm not sure that, I mean, a HELOC, most people don't understand a HELOC. They don't understand that closed in second. And I mean, what is the best product for me? That's where you all shine. And
Right.
that's what we're good at.
Oh, wait,
Right.
no, it's not the one with the lowest start rate on that
It
HELOC. That's
almost
not the
never, I
best
mean,
product.
one of my best sales tools was if somebody would say, oh, your rate's a little bit higher, and I would just say, or in your points or whatever, I would just say, man, if you're asking those questions, you are so out to lunch. uh, that you need to actually you call somebody else, right?
Yeah.
Because that you're not even in the same ballpark of where you should be. And it was
So,
like, what do you mean? Well,
Bill,
okay.
had that a million times that like when people, if their first question is, what's the rate? I hang up on them or I slap them around. And I've gotten beaten up for that comment. But to your point, I want to work with people who understand that I have value, that I know how to strategize, that I can take their situation and help them turn it into something better than just what is the rate. And again, we all want them to have good rates. I mean, I never wake up in the morning and think, you know what, today everyone gets the highest rate I can find. I mean, that just doesn't happen. So anyway, okay, we have some good questions and comments in the chat. So Rick
Mhm.
said Australia's origination model is 50 to 66 basis points at origination and from 12 and a half to 30 basis points annually if the loan is performing. That's an
Mhm.
interesting idea. I'd love to like know more about that and see like how on earth we could get that into our system. Although we did take a run at Australia's other mortgage idea, which is that, the first is a
The
heap.
Macquarie loan, yeah.
You write all
I
your
mean, Chris George has always loved the Macquarie loan, right? What do you call it? The appreciation mortgage, or I think
Equity accelerator, he called it one
I
time.
love, I mean, and Chris is
What a
great at
great
this,
program.
right? In thinking about it, I think I think the same thought process should go into, you know, loan the length of the loan and how long you want to keep it, all the stuff that you were just talking about, right? I think for
oh,
consumers, um, for loan officers,
Hmm.
the right compensation structure. I mean, and I offered this to consumers back when I had Own It, where our brokers got paid, we called it dividends. And
Hmm.
so the broker got paid X up front. They could be paid over 3 years. And what we were in, and we had, now think about it though, we had prepays. So we would waive the prepay 1, 2, and 3 years based upon the performance. If you're current in year one, if you're current in year two, you're current in year three, we'd waive component parts. What I tried to do with the product was what you just said is done there is you should take compensation and spread it to stay connected to the client, two, refinance them if necessary, three, make sure they're paid and deal with the
Well,
forbearance, the foreclosure,
you're
the difficulties, right?
if you are paying the loan officer over on the performance of the loan, you're incenting the loan officer to produce good
To do
client.
the right thing.
Yeah, to do the right thing,
I
which is
don't
like,
get,
what's wrong with that?
I
Versus
think,
penalizing us for things like, oh, wait, they didn't early pay off.
yeah, the
And
so
we had no say in it. We had no control over it. Some
Mhm.
cold call person called them. Audrey, you I know someone who had it where the sellers or the servicer sold the loan and then was doing a 6 month prepay on it.
no, that wasn't it, but close. So my borrower was sold to, I'm just going to say it, Freedom Mortgage, and Freedom was soliciting the borrower for a refinance, like nonstop calling them before the EPO was up. And I'm like, how is that okay? Like, that is so egregious. It just, oh my God, it made my blood boil.
And would Freedom then collect the
I,
early
They
payoff
would
fee?
either waive the fee
I
to
don't,
their if you came back through them or
I have
something like that.
such bullshit.
Yeah, I think if you think about EPO, you think
Mhm.
about EPD, you think about FPD, first payment, early payment, and EPO, right? It could be easily because what compensation lawyers were telling us was that the loan officer doesn't do anything post the closing. And I said in mine it was always, well, I think let's just say they don't do anything. Well, if they don't EPO it, that's a good thing.
The
If
great
the
thing.
client makes their first 6 payments, that's a good thing,
Yeah.
right? When the horse stumbles out of the gate, it's not a good thing, right? And it's either fraud or we got a bad horse,
I
right?
mean, when he runs the
So
wrong direction altogether.
whatever, he knocks the other guys out of the thing. I mean, it's like it's a bad commercial. But I think my point to them was, it was to compensation lawyers, was it doesn't matter if they don't do things, they then it's positive to the loan. If the loan pays, that's positive. And if the
Hmm.
loan gets through those three hurdles, that's positive. Now, why wouldn't you want to pay the LO to stay connected to the client?
Yep.
And I think forbearance, I mean, if we think this through, who got all the calls in forbearance? Well, you couldn't get a hold of the servicer. I mean, you couldn't get a hold of the old lender. They might
Hmm.
be dead by now. And then here you are, and you're getting
Yep.
calls, and then people are telling you, you can't say this, you can't say that, you got to be careful, you got to do this. I mean, like we lived in fear because our fear was that our loan officers wouldn't say the words, we would say the words forgiveness, the word
Oh,
forgiveness, and not the word forbearance. And
oh,
those are two different words. And the challenge so my point would be that I do think loan officers stay connected, and it is stupid for us to pay everybody at the closing table and be done.
Yep. Yeah, I agree.
And if you were trying to build a brokerage business, wouldn't it be nice to be like an insurance agent and have some
Yep.
annuity,
Got
Yeah.
some
right?
annuity coming in.
Yeah.
Yeah.
Keep building that among them. The only
And the
trick is
moment
who do you pay when the loan officer either gives up their license or passes on, or
the
I
good
guess
news
they
with
pass
that is it
on.
goes to the house and we've got more money to spread around.
Yeah, whatever. That's yeah, and
Right? I
how
think I
never
think the when you leave, you lose. It's sort of like vested options. I mean, if you have options,
Yeah.
right, in a company or something like that. I like to think that it's hard. It's a little bit like the portable question. When you leave, I mean, if I were a lender, wouldn't this be a great retention tool?
Yeah.
I mean, why am I paying signing bonuses to a
Yeah.
bunch of people who do two loans a month when I could be providing you compensation to stay
Hmm.
with me over a period of time
Yep.
on loans? I mean, if you really think about it, the problem is we've created our own monster
yeah.
because we don't have
Well,
any other compensation. So you just go, I'm out, I'm leaving this company, I'm going to that company. It was like, well,
actually, what is it stop
what
it?
industry actually does this? I don't know
What
any
would not?
industry.
How would you stop let's say ABC Mortgage decide to pay their loan reps or loan officers 50 basis points per deal closed, and then some
I
smitten
think you'd have
staff.
to do it. I think, Kevin, we'd have to do it differently, right? Because the moment I would cut their comp, everybody would leave. So I'd have to pay them more. So the way I would do it is I would pay them just what their current comp plan is, and then I'd have a deferred comp plan that's theirs
Uh-huh.
for all their clients, and I would pay them, which, I have a deferred comp plan. I recommend a deferred comp plan to all my retail clients. Why? Because I want to retain the freaking loan officer,
So
right?
I had this somewhere, and I'm trying to think back in my brain through the haze
And
of
that is legal, right? Because if I just put performance metrics,
Yeah.
I can pay you more,
Yeah.
right? Because I could say if Audrey and Kevin's performance last year, if their loans performed, if they did X amount of purchase, if they did Y amount of this, and they did, and I had a performance metric where you didn't piss off all the operations team.
there you go. That's a
Yeah.
biggie. Yeah.
All of those could be okay. Based upon that, I give you 10 basis points.
So I think I had a comp situation once where I got basis points on, I'll have to think about that. Okay, so we have a question here. Can LOs be paid a piece of servicing as that annuity, or does that take too much skin out of the game of the benefits of servicing? So, what are your thoughts on that?
Yeah, it's hard because it's skinny, because everybody's trying to get some massively low price into the loan. So there's very little fat in the servicing spread. What I've seen work, and I'll use companies like Movement and some of that, is they allow the loan officer to defer some of their comp and own part of the servicing, which I think is a great idea,
Interesting.
Or
right? So
maybe buy
you
the
could take
service.
10 basis points of your 120 plan and own and invest in that servicing. They also give you the right to actually invest in it, right? Where you actually could put money into a pool, that pool owns the servicing. Anything that we do, I think, to allow us to retain the client and get closer to the client is good. And I think anything that we do to annuitize your volume and your production is good and as a
Hmm.
retention tool, right? Because I mean, I know when Skyline and NewLeaf and Cloud Virga moved over to Finance of America, we basically sold. and FOA bought our business. I had a bunch of retail people. The main reason why all those people transferred was that we had a deferred comp plan.
Mm,
And
interesting.
all of them at least gave me a shot, right? When we moved over, because they would get that money upon completion of the deal in June or something like that, right? So, but it was, and it's a sizable amount of money, right?
Yeah.
So I think when you're thinking about basis, I think annuitizing it, we need to basically, as an industry, and this is where Audrey, where you guys can help, right? Because I think we need to lobby to change the comp rules. And because the comp rules are wrong, right? They just flat are. One, I'm not really sure we're employees at all, right? And brokers operate differently than loan officers who work inside. We need to
Yep,
be able to deduct our expenses,
Yes.
right? We need to be able
absolutely.
to, and we need to be able to receive income that is more annuitized on a loan. So I would go back a little bit to what, the chat room was talking about, where we're paid X and we're paid Y on our loan based upon the performance of the loan. And that
Right.
it's not that big of a deal, right? When you're starting to listen to compensation lawyers talk, because if you're paying on performance, everybody's sort of good with that.
What's really great about it is if you're being paid on performance and suddenly you know that Jim Jones you didn't get their monthly check this month, you're going to call Jim Jones and say, "Hey, I noticed you didn't make your mortgage payment. Anything I can do to help?" Um,
Yeah, and I think that's the purpose of it. It's, to me, it sort of sits almost exactly to the purpose of what a loan advisor
Yeah.
does. Our job isn't over when the deal closes. Our
mhm.
job just begins,
Yes. Yeah,
right? I don't know why we call it a closing. It
exactly.
it should be an opening, and it should be, you're my client for the rest of your life,
Whether
right? So now how do I get paid for what all the work that you all do
yes,
to
for free.
advise these clients is never paid. It's sort of stupid if you think about it.
This is something when we've talked to the regulators, and which we do regularly, that first of all, we can't get any of the associations to get interested in helping us get our ability to deduct business expenses back. Like that is so far down the list. And it's such, again, bullshit. But with regard to the regulators, they don't understand either because they have always gotten a paycheck. This
Yep.
people in management, in mortgage, and in ops, they get a paycheck every 2 weeks. That's just, it just happens. And we don't get a paycheck unless we close something. And then we are at risk during that EPO period of having to have our commission taken back, which I just think is the most egregious pile of crap. And I don't know who came up with this system, but it's been in place since I've been in the business. But that needs to change because it is not fair to us because we do all the work and we're not refinancing. If we did, sure, take our commission back. Absolutely. I get that. But that's not the case. So, yeah.
Yeah, I mean, it is my number one pet peeve with Dodd-Frank. Forget the referral
Mhm.
BS and all of that. That made sense to me, right? Paying for referral fees and
Well,
going back and forth and having to pay the realtor and having to pay your joint venture partner and having to pay the title company. And I mean, it felt like we're in a bad mafia movie, right? Over Christmas. It's like, and so, but I think compensation and not allowing us to be paid past closing is patently wrong because it flies in the face of what we do, right? And so I think now with the CFPB being in the penalty box and Dodd-Frank sort of being, an old law, right? And we've all worked through it over the last, what, 15 years. mean, this has
Yep.
been, so I think if we're going to innovate, we have to figure out how to innovate compensation to fit. If not, we're going to continually get people just jumping ship like mercenaries.
Yep.
Right. And that isn't, I mean, a company, when I had a company, if I have a retail channel, I want those folks to have, my name here, their name there. I want them to be part of the organization. And
Yep.
yet it's hard to do unless you create compensation plans around retention.
Yeah.
So we have a comment here from Tony who points out that there are LOs out there who will grind people and refinance them every chance they get within
You
a
know, the big banks do that. They don't have early payoffs if you work for a big bank, and
class.
they will just refinance you, refinance you, refinance you, refinance you. And the thing is, what people don't realize when that's happening is that they're not saving money because the rate went down. They're saving money because their mortgage payment got extended out in a couple more years.
Possible.
I think that, I mean, there's a whole bunch wrong with that, right? Because
So many.
when you start paying into a mortgage, right, it doesn't pay down the principal. I mean, I actually think part of our job is to teach them, look, if our job is to maximize equity for a client,
Hmm.
what are we gonna, is our real job is to let home price appreciation take care of it?
Yep.
Well, you didn't do shit.
Yep.
But what if you took home price appreciation going like this and you put an accelerated payment schedule?
Yep.
Then their equity goes like this. Okay. Now we're starting to talk, right? So whether you convert, pay more, or whether you pay it differently. I mean, look, I invented initially years and years ago this biweekly payment. Chris, I mean, how the more rapid you pay the mortgage, if you paid it
Hmm.
twice a month instead of once, it pays off in 19 years. Well,
Yeah.
you save this amount of, so people that actually have the means to be able to do that, great tool.
Yep.
Others obviously won't do it.
All right. I'm going to take, I think, hopefully 1 minute. I'm going to rip through a bunch of things that people can just chew on. First of all, GDP came in for Q3, the first look. It came in at 4.3%. They expected 3.3%. Annualized, we're at 2.5% growth rate this year, but we still have the last look at Q3 and we have Q4. So we'll see, but that was a strong reading. Unemployment, ADP weekly unemployment was up a little bit after weeks of negative numbers. Their weekly report came up positive, so we'll see how that goes. QCEW, which is quarterly census of employment and wages, came out for through Q2 of 2025. As usual, it is off big time, but because Kevin and I had a labor economist on our show who used to run the division of BLS back in the day that produced the report, we know that the question being asked by BLS is different than the question being asked for QCEW. And so the numbers are not quite it anyway. So that's a whole nother conversation for another day, which we've had, by the way, on the show. So you can go back and watch that if you wanted to. Unemployment has gone from 4.1% in June to 4.6% now. That's a fairly hefty increase in a short amount of time, so keep an eye on that. The rent indexes are showing that rent is definitely slowed way down and is negative in a lot of places. Existing home sales, according to NAR, we are at 4.13 million units, 0.5% annualized pace positive. We had positive revisions to October. 18% of homes were still selling over list. So everyone's saying the sky is falling, and that's the same number as last year. 20%, 27% of the market cash buyers, 18% investors, 30% first time home buyers. So, things are pretty similar to last year. CPI came in much better than they expected, but we did skip October. This was a November report, so it took us from September to November. So I've heard some people poo-pooing that CPI number, and maybe it's off and, extrapolating from all these other sources to come up with their own, but we'll see. I mean, I think that because of the shutdown, we have some missing data. Maybe things are a little funky, but at least we're getting some better numbers there. That's a
Mhm.
good thing, I think. Yes.
What happens when the next shutdown?
Yeah, yeah, that's what is that January 28th that the money runs out
Coming
again?
up? Yeah.
Okay. But I think overall we look towards 2026 and we have a plan. Make a plan. Do it this week and next week. When you have a moment, jot down what you're going to do differently, what you're going to do the same, all of it. Because you've got, if it's not in writing, it's not real. And if you don't have a reference point and a way to check in, we I can't even speak. Brief and maybe putting together some sort of group of people who wanted to have some accountability. I don't know if I mean, some people express some interest. So make sure everything's in writing and don't expect rates to decrease a whole lot, right, Bill?
No, I think you're right on. I think you're going to get a little QE7 or whatever, right? We're going to get a little support from the government. I think Trump wants the rates to come down, so you're going to get a new Fed governor. You're going to get some change there. I think the biggest thing that you might get is a compression between the bid and the ask between, I mean, because it's historically wide, treasuries and mortgage backs. So I think all that stuff compresses a bit. So mine would be build a plan, right? Make sure that your plan is make sure your plan is actionable. Call and begin to contact your clients on a regular basis because you want to be the person that's when because I think this is the year when they wake up and go, we got to do something.
Yep. And okay, can you in like 30 seconds tell us so the GSEs are going to or have started buying mortgage-backed securities. Do you think that's going
Mhm.
to have any impact at all when you
Yeah, I do. I mean, it already has to some extent, right? I think you don't have to have the 10-year go below 4 to have a quarter rally in what we're doing. My point would be the treasuries and mortgage backs could actually tighten just on its own. And the support of buying more mortgages, if the agencies buy more mortgages, rates will improve, right? Just in general. So I think I think that plus look at the intermediate products and begin to get yourself set up with somebody that can offer because you want to have a conversation. When you're having a conversation with a client, you want to be able to offer a lower rate than what they're thinking. If a client called me on a 30-year refinance, I almost always talk to them about an intermediate arm at a lower rate just to give them the bid and the ask. And if they called me on the intermediate arm, I talk to them about the safety of a 30-year fixed,
Yep.
right? I tried to help them understand that you're probably asking the wrong questions and here are the right ones,
Yeah.
right?
Yep. All right, Bill, thank you very much. Thank you very much for
You're
being
welcome. Merry
Happy
Christmas, you
birthday.
guys.
Enjoy the
Thank you.
holidays.
You
See you
guys.
next year.
Festivus. And to everyone, we are so grateful for you and all of your support this year and every year. And we are going to take next week off, our 1 week off of the year. And we will see you again the first Tuesday in January. So,
Many
with
blessings, y'all.
have a wonderful, wonderful holiday. Mwah. And by the
See
way,
y'all.
keep working, close your loans, or your
Close.
in February are not going to be fun. Okay. All right.
Yep.
Great one,
See
guys.
y'all.